Well, welcome to everybody to what I imagine is going to be a really fascinating talk. And more than imagine, I've heard a dry run of this talk given at INET in Paris 4 or 5 weeks ago, and you will find it a fascinating talk. It's a great pleasure to welcome Patrick Honohan to speak to us. He was in and out of academia and international institutions and public life on both sides of the Atlantic in the period before he became governor of the central bank. Like everybody in such a position, you always look carefully at the CV, and there's a few lines down before you get to the International Monetary Fund. But he, like everyone else, spent some time at the IMF, but also at the World Bank, and also, I have to say, at the Australian National University, doing other things different from what he did at the fund and the bank. He originally did his undergraduate work at University College Dublin and was a PhD student at the LSE in the 70s. And has taught in a number of places, and then was whisked into public life as governor just before the crisis arrived, and had that work to do. Great pleasure to have you come and talk to us.
Thanks very much, David. Yes, I was just recalling walking up here this afternoon that the last time I was in Oxford, I think I was a discussant rather than giving a talk, and it was for the Oxford Policy Review, the Economic Policy Review. They had a special issue on housing markets, and I remember afterwards some very distinguished people talking about. The date was in September 2007, early September 2007, and the view was not a problem. Get over this, because already we had August 2007, early indications of quite severe problems. General view was not a problem. And I remember saying, yes, but if a big bank went down, wouldn't that change everything? And the big bank that went down first, of course, was Northern Rock, and it was within about 10 days. So I won't mention the names of those people, still very able and distinguished people, and you can say what you like anyway at a conference. And if you don't, knowledge will not progress. It was, of course, Max Watson who asked me to come to this group and to this research program. And I just mention why Max knew me. Of course, I knew of Max over the years, but I didn't have any particularly close dealings with him until after I was appointed, which was this job, which was in September 2009, well into the crisis and well into the problems. There hadn't been any kind of examination, any report. What actually caused this problem in Ireland, and after some prodding on my part, the government decided, yes, we will have an inquiry, and there will be various stages to the inquiry. But the first stage will be 3 background preliminary studies. And of course, these preliminary studies, to some extent, became these studies. One was on the central banking and regulatory structure and the failings in that, which the government gave to me a real hospital pass, because you can imagine the complications of that. And then they also had a study of the Department of Finance and things that could be improved there. And then the study on economic policy in general. And that they got 2 people who knew each other very well for a number of years. Klaus Regling, who had been not only in the IMF but also in the Commission, and who had just left him, he retired. He's now the chief executive or president or whatever it is of the ESM that provides all the money to Greece and Portugal and Ireland and Spain and so on, and Max. so Max came along, and we were writing our reports at the same time. So it was a wonderful man to interact with, because Klaus is very astute and watches what's going on, and Max talked all the time.
Yes.
So they're a wonderful team.
And did quite a lot of watching of Klaus as well.
Anyway, the reports came out, that was fine, but the government decided that they wanted a new legislation governing the central bank and a new governance structure. So they swept away the old governance structure and put in a new commission, central bank commission, which is the decision-making body for the central bank, but they delegate everything to me and other people. And they needed new people for that, and in particular they needed an outsider. So Max, having done such a great job on the report, they thought this is the man who can keep the central bank embedded in an international world and understanding the international world. That commission was appointed on September the 30th, 2010, which was 6 weeks before Ireland entered the programme. So I had the task of telling those new arrivals exactly how bad the situation was, and I told them it in terms of two figures of 100 billion euros. Well, that seems probably a lot of money even here in Oxford, where I know you're very well endowed. But in terms of Irish GNP, 130 billion was GNP that year, so 200 billion. 100 billion was the losses that had occurred in the banking system, some of them borne by the shareholders of the bank, some of them borne by foreign shareholders of foreign banks that were working in Ireland, and the rest of it being borne by the Irish government, which had guaranteed all the locally controlled banks in September of the previous, two years before. The other 100 billion was the amount of money that had been borrowed by the ECB in terms of liquidity to keep these banks afloat, because they had sourced money from everywhere and that money wanted back. And the ECB had of course filled the hole. If we weren't in a monetary union, there would have been a devaluation. If the borrowings had been in foreign exchange, well, they wouldn't have been paid. But we are in a monetary union, so it was just a question of shifting the creditors. So I explained this fact to the new commission. They were all very, very upset and alarmed, and weren't sure Max would have been more aware of the others of the scale of the situation. They weren't sure whether they had made the right choice of accepting the offer. So Max, I think, provided an anchor to this commission, because he'd been here before. Anybody who worked in the IMF has seen this kind of a problem in various countries at various stages in the past. And it was really wonderful for me to have him there, because if I and my colleagues were making quick judgments and quick decisions which would seem obvious to people who had seen other countries, well, they wouldn't necessarily seem obvious to people not coming from that scene. Max was able to say, it's all right, he's got it right, it's all right, it's going to become all right in the end. Max only stayed about a year in it, and he wanted to get back to Oxford. There was a lot of travel to Dublin, and he wanted to get involved in other things, and I was very sorry that we lost him, sorry, but he was there at the crucial time. Anyway, that's not what I wanted to talk about. I wanted to talk about the topic of your research program, which is the political economy surrounding this kind of situation that Ireland has found itself in, because we went in 6 weeks later in November 2010 to a program of financial assistance, which was an EU IMF program, so it had Troika, now called the institutions, you can't call them the Troika anymore, the Commission, the ECB and the IMF. Crucially the IMF, because they're the people who have known how to do this thing. 67.5 billion euros was lent by these three, which was just about 50% of that year's GNP. Now, over the years since then, some myths have built up, and some harsh comments have been made. some of the commentary is spot on, but some of the myths tend to get mixed up into the commentary. And so I'd like to go through some of the myths and some of the true facts, and then I will mention a few partly true facts. And I'd like to focus on the international dimension, but first I think I should say a few words about the background to the bailout, the things that went right and went wrong, especially the things that went wrong in Ireland in the years before the bailout. So I'll just do it with facts and myths. I can't quite remember how many facts and myths I've ended up with as well. There's myth 6 is the last one, and fact 4.
More myths than facts.
Yeah, well, they're more interesting. Well, there's a fact, but actually some people lose sight of this fact. It's the unrestrained and reckless behaviour of the Irish banks that destabilised the economy and the public finances. Now you can allocate blame in different ways, but in my view, the first line of defence against what has happened must be the directors and managers of the banks. So we had over a few years, it was a credit-fueled bubble, created a pattern of over-indebtedness, mispricing of profits, mispricing of wages, mispricing of house prices, and because of that pattern of mispricing and over-indebtedness, Ireland's economic performance during the Great Recession has been one of the worst in all the countries that have been hit. With greater prudence by the management and boards of the lending banks, the bubble couldn't have happened. And by the way, the international lenders too were an essential part of the process, because the banks couldn't have lent all that money if they hadn't borrowed it all from abroad. And they were surely lucky to recover, as they did, all of the funds that they complacently advanced to fuel the boom. And I have a little slide showing. Now remember, 130 billion, that's the GNP in 2010. I think that's 2009, I mix up the years now. And so look, these are pretty big numbers here. 20,000 back in 2002, not 20 billion, 20,000 million, 20 billion back in 2002. And then you see from 2004, and you see this very, very rapid rise in the liabilities of the banks to the rest of the world. And this is just the retail banks. I'm not including here the offshore banks that are located in the financial services centre. This is just the retail banks. And you can see how their liabilities grew to about 100% of GDP, and how then they collapsed subsequently in two waves. A wave immediately after Lehman's, and then a wave just at the time that Max arrived. See what he calls? Just why? Because that was the end date of the original bank guarantee. And during the 2 years of the guarantee, of course, banks said to creditors, look, will you roll your money? And the creditors often said, no, we're not, we're taking it out. That's the first decline there. But sometimes they said, well, considering the guarantee, yes, we will leave our money. In fact, we'll leave it for, when's the guarantee ending? 30th of September 2010. Okay, August 2010. We're taking no chances. Or early September 2010. So that's how you see these big declines. When they were asked again in August and September 2010, won't you roll it for another one? Guaranteed? No. Irish government doesn't do any guarantees anymore except for deposits and short-term things. So that was right. That's one fact. And it's related to the...
Can I just ask, where exactly is Lehman on there?
It's probably before the... I can't get an angle so my finger goes... No, it's around there. You see the first of the very steep falls. No, I think that's wrong. I think it's...
It's 2008.
2008. It is 2008. I can't remember.
Nearly at the top, isn't it?
You see, the guarantee retained the funds, and for a while, and then people lost confidence in the guarantee because they thought, wait a minute, this is a very, very big guarantee. I'm not sure the Irish government could pay this. So I think it's early in 2009 when the big fall comes, and then it stabilises again for a while, and then falls off in the way I described. So I don't think there's a very can't remember quite whether we're exactly
The
lame it
problem
is.
is that your chart producer doesn't tell you when the year starts and when it stops.
The years,
But it looks
yeah,
like, that
yeah,
looks
yeah,
to
no,
me
it's-
as if it's, the peak at the top there is around about late 2007, which is before Lehman.
Yeah, no, the very peak is. Yes, that's right. I just can't remember which of those, which of the first of the reasonably steep things is. I think it may be a little bit after Lehman. Okay. No, the property boom had ended a long time before Lehman, and so the economy was sliding into recession then. But of course, other things. So now here's a partly true, because I put this one up. It was lax supervision that was blamed on Ireland. It is, of course, it was. But it's only partly true, because I think everyone in the room may agree, that's a provocative statement, that any attempt to assign responsibility must start with the banks. They're the first line of defence. The bankers are, you don't say, well, I'm sorry, we lost all our money, nobody regulated us. Banks have a clear responsibility. But we can't neglect the ineffectual supervision that failed to inhibit this banking behaviour. Now, I would say the supervisory flaws were their nature was similar to what had happened in many other countries. Remember, 8 or 9 countries across Europe had quite serious banking failures. The same kind of regulatory style and approach and lack of second guessing resulted in that. But in Ireland, the scale of the bank credit expansion and the associated construction and housing price boom was of a different life-threatening order of magnitude. So here in the UK you had serious bank failures, but they weren't so big as to destabilise the solvency of the state. They weren't so big as to cause the previous build-up hadn't distorted the economy to the same extent. Credit expansion on the Irish scale should have rung alarm bells, triggering much more intrusive examination of the vulnerabilities, and corrective measures should have been introduced. Well, I could also talk about the other policies, but I just want to make that contrast. There's a tendency now to just blame the supervisor, and I think that tends to let the lenders off the hook. Here's a myth. No banker has been convicted. Actually, for the most part, unwise behaviour rather than criminal seems to have been what happened with the bankers. But there have been convictions of some senior Irish bankers found to have committed a criminal offence in the later stages of the crisis. So just in case you don't believe me, I know you'll believe the Mail online, and if you don't believe the Mail online, you will believe the Financial Times. But no prison sentences, and there are a number of other cases, criminal and civil, in preparation. But I actually do think that Irish legislative framework deserves to be strengthened to take account of egregious recklessness in risk-taking by those who are in charge of failed financial firms. And you have here in the UK recent legislation of that type, and I think that could be usefully mirrored in Ireland. Well, here's another myth. It was the bank guarantee. You see, you'd have been all right without the bank guarantee. Well, it's not chiefly the bank guarantee that brought about the need for fiscal austerity and generally crippled the Irish economy. I would agree that it was market alarm at the scale of the funds that had to be injected into the banks in 2010, and which were recorded promptly in the general government deficit, which was published during September 2010, and that was a wake-up call. We had a general government deficit, as measured by the Eurostat, of 31% of GDP, which is kind of sort of silly. I mean, how can you have a deficit of 31%? It's a capital item, but it is counted as the deficit. Don't ask the statisticians why they do that. But that was quite an alarming number, and it caused attention to swivel over to Ireland, whereas it had been on Greece up to then. It was a wake-up call. Global attention, the fragile fiscal situation, and it brought forward the need for action. But actually, redressing the emergent deficit in day-to-day spending was going to require a much larger, because permanent, adjustment in government revenue and spending. And that's because of the degree to which tax revenue boom time tax revenue fell off. The boom had been so long that the government was getting in more tax revenue than they needed, and so they kept cutting the reliable sources of taxes. They kept cutting income tax. They said, oh, we're getting loads of revenue from housing transactions, profits, so we don't need to charge income tax. Income tax is politically unpopular. Nobody really minds paying stamp duty on a house when they think their house is going to appreciate in value by more than the stamp duty in a few months. So the tax system had become very vulnerable to a downturn. And that is really what caused all the austerity. I have a chart that I think this one shows. Yes. So I just included corporation profits tax, capital gains tax, and stamps. I see a lot of them stamp duty on residential property. And you can see how the reliance grew right through the boom period from 87 right up until 2006. And it went from 7 or 8% of the tax revenue to 30% of the tax revenue. And of course it fell like a stone. Thank you very much. There's another chart here that shows you something. It's a bit more complicated. Let me stand up and try to explain this. I'm trying to distinguish here between the amount of austerity, by which I mean changes in policy that increase taxation or changes in policy that reduce spending. So they don't have automatic stabilizers in it. I net out those. Now the red ones have to do with how much the banking, paying off the banking guarantee, recapitalizing the banks. Those costs are shown in red. And the rest is the rest of the austerity measures that were adopted. Now, on an annual basis, you can see 2008, nothing very much. 2009, the government is already starting to adjust. The blue line is starting to get quite big. The red line, small injections of capital into the banks. 2010, that's the big injection of capital into the banks. And then falls away in 2011. But every year, there's more and more of an adjustment until you get up to 2014. 2015, we have slight easing of the budget for 2015. So you can see the blue line is a little bit less. Now, then those are the annual adjustments.
Can I just ask, those are enormous numbers.
Yes,
They're
huge.
A quarter of one year's GDP.
Huge. Big adjustments.
Stupefying numbers.
Yeah. And of course they accumulate because then every year you're saving that much. So every year from now on, unless they ease a bit, they're going to be 30 billion more more tax, less spending than there would have been if you had the policies in place that were in place in 2007. And so that accumulates, and I've made it accumulate here. You see it's going up to 150 billion or something like that. And the banks, well, the banks have done. Banks have recapitalized. The ECB, single supervisory mechanism, checked all that. So there's no problem, no more government spending for the banks. So that's why I say that it's really very misleading to think that, oh, we are paying for the bankers. Yes, paying for the bankers because the mismatch and the distortions in the economy are caused by this banking-driven boom, but not paying for the bankers in the sense of paying for the bank creditors to the extent that the guarantee covered them. So I think it's quite an important point. Now, well, another myth, that's myth 2. Myth 3 is, well, maybe nobody thinks this. The bailout caused the Irish recession. Well, actually, a number of people do think this. They say, wasn't it just awful that we had to go into that terrible Troika program? Well, actually, it wasn't. It might have been awful that we had to, but the program itself was not the cause of all the austerity. The austerity was, happening anyway, going to happen to the extent, and would have been more if there hadn't been the availability of international public funding at low interest rates. I'll come back to the interest rates in a minute. So this would have seemed preposterous. The bailout caused the Irish recession would have seemed like a preposterous proposition to anybody in 2009, 2010, because they knew, they could see what was going on. But that seems a long time ago to some people. I can imagine giving a talk like this in 20 years' time and I was saying, some of you weren't born when this happened. But people have forgotten, and they do think to some extent that it's the Troika came in and said, got to stop spending, got to increase your taxation. Well, in fact, the Troika gave the government funds to ease up on the program of austerity, and it would have been steeper than otherwise. A few slides show that, just in case. Now, the two vertical lines are Lehman's and the program. I think they're about right. Yes, you can see that GNP, GDP were falling, quarterly, were falling before Lehman's, kept on falling right into early 2010, if you like. And then from 2010 until 2012, bouncing around without any real trend, and then the upward trend from 2012. There's no way that you can read that those graphs to imply that something awful happened in November 2011 to sink the Irish economy. On the contrary, it started growing fairly November 2010. Might be another slide or two of that type. No, that's all. No, there is. Yeah. No. That's employment, total employment. This is the worst part of the recession, because GNP and GDP tend to grow in Ireland in sort of jobless recovery type of dimensions. We're not in a jobless recovery. I'm sorry, the television cameras are on. We are not in a jobless recovery. We have a job job growth as well as economic growth. But the GDP numbers in particular really flatter the economy. So I want to show you the job numbers, and jobs are way below, still way below what they were at the peak. They'll get back, but it'll still take a number of years. So that is a very important picture and level to be aware of. Everybody likes a recovering economy, and we have a recovering economy, but let's not forget that it's an economy that's well below peak. And you can see the two vertical lines there, the same as before, the Lehman's and the bailout. And construction employment has recovered even less. Well, that's not surprising. I mean, never expect 270,000 construction jobs again, I wouldn't think. All right. Now that's on the lead up to the, that's the Ireland part of the story, and then the story then is, how did the institutions relate to Ireland, and did they behave? Was their contribution as good as it could have been? And so let's look at a fact here. Yeah.
Don't you think that the currency union was also to blame?
Okay. Well, I think. Can you hold that one? I think one of my myths or facts, because I selected a few, may answer this question. If it doesn't answer, ask it again at the end. Okay. Oh, sorry. No, house prices. That's another story. Won't bother with that. Well, here's a fact, and it's not very well known, but I think it's very interesting for your group here and for the political economy of financial sector reform. The IMF staff, going into the program, they wrote a report for the executive board of the IMF, who are the deciding body of it. And in the report, which was public on the web right away, they said, I've got a quote. Oh, I think I have a quote. So this is all copied from the report. The various criteria have to be satisfied if the IMF is to lend to a country. There has to be a sustainable debt position. That's criterion 2. And the definition of a sustainable debt position is that a rigorous and systemic analysis indicates that there is a high probability that the member's public debt is sustainable in the medium term. Okay, so that's the general rule. Don't lend to a country if their debt is not sustainable. Do something about the debt if it's not sustainable. However, in instances where there are significant uncertainties that make it difficult to state categorically that there is a high probability that it is sustainable over this period, exceptional access would be justified if there is a high risk of international systemic spillovers. So this is the systemic risk exception. And when did the systemic risk exception come in? In May 2010, in the context of Greece. This is a new IMF rule, was developed only 6 months before, and here, okay, Greece may be considered a special case, but here in the very next major program, the IMF finds itself again in the systemic risk exception. So the words that they said, the staff said, it's in red there. Even though uncertainties around such a debt path make it difficult to state categorically that this is the case with a high probability, fund support at the proposed level is justified given the high risk of international systemic spillover effects. So, should we be very pleased in Ireland that we benefited from this systemic exception? Well, yes and no. Yes, because everything worked out in the end. I'm not so sure that this is a systemic risk exception is something that borrowing countries should welcome with open arms. On the contrary, it risks taking a country into a situation where they are accumulating more and more official debt, okay, less and less private debt, more and more official debt in a situation where nobody knows where this is going. And the staff aren't confident with high probability that the debt is sustainable. So I think for a borrowing country, if they see systemic risk exception is being invoked, they should be nervous. Well, actually, the Irish officials, including myself, were nervous. We also felt that, we agree with the IMF staff, we felt in particular that if the Irish government had to use all of the 35 billion, almost half of the programme that was earmarked for bank recapitalisation, there was going to be a stress test, and another stress test, and then banks recapitalised up to the standard, and the lenders had penciled in 35 billion of the funds to be used for that. We felt, officials in Dublin felt, if we have to use 35 billion, we're in big trouble. We probably are in a debt unsustainable situation. So why did we go ahead? Because if we didn't go ahead with this, the adjustments to the budget would be much more severe, because this was the funding that was going to allow the following 3 years of gradual fiscal adjustment. I'm sorry, not so gradual, but as you pointed out, quite severe, but less severe than they would have been otherwise. And we felt, or certainly I felt, if this isn't going to work, the official lenders will adjust the programme. This will be fixed. Somehow this will be fixed in an orderly way. One of the reasons we felt it was...
Can I just
yes.
understand that argument? If you've got 60, I think 60 is the number that we go up to, and if you spend all of 35 on the banks, then the remaining 25 has got to cover you all the way to get back to zero, roughly speaking. Is that the argument? And
no, not really.
25 isn't enough to get you back to tide you over until you're in the end capable of.
No, it's not that's like a cash calculation. Like we'll run out of cash before the end. No, it's not. It's a net present value calculation is what I have in mind. If the banks are so bad that they need 35 billion in capital, then the net debt of the government is much worse, and we're already feeling that we're teetering on the edge of sustainability. And one of the reasons the net debt is bad is because the interest rate at which, although much better than the market interest rate now because the market has lost confidence, the interest rate on these loans was initially 5.8% per annum. So why was it so high? Well, because it's an exceptionally large loan for the IMF. It was a multiple of the quota, and the more times of your quota that you borrow, the more you pay a surcharge. And the surcharge brought it up to 5.8%, and the European money was priced at the same. Yeah. Say what does the IMF lend? Okay, 5.8. They've done the calculation. We'll charge you 5.8 as well. So all this huge block of money, 50% of GDP, was going to be over a period of time, 5-7 years and longer in some cases, ultimately longer, would have been charged these interest rates. So we felt this is really not going to work if we have to put 35 billion into the banks, which we are not going to get back. The other one is just a question of if we can get the market interest rates lower, then we go back into the market. Now, in fact, the stress test showed we didn't need that much at all. and in fact we lowered the cost of the government even more by bailing in subordinated debt holders quite aggressively. Following all through, we'd already been bailing them in, and we bailed in more than after that at the stress test. So we only needed about less than half of that 35 billion, and then subsequently there was a very sharp reduction in the interest rate charged by ESM, the European funds. They were lowered to basically cost plus a small margin. They went away from the idea of pari passu with the IMF, and that was part of the Greek situation as well. They recognised this doesn't make any sense for Greece, and it doesn't make any sense for Ireland. And then subsequently in the liquidation of IBRC, which was the notorious Anglo-Irish bank folded into another entity, that was liquidated in 2013, and the government was on the hook for a lot of its debts, but the financial arrangements around that were also quite a lot better than you might have expected. So as a result of that, we moved from on the edge of unsustainability into something quite sustainable. But it's an interesting question for your group to think, well, do we really want this systemic risk exception, or should we not say, if there's a systemic problem here, let's find somebody else to pay for it and not the borrowing country? Very important point. I don't think there's should be any residual complaint from Ireland about this, because of what I've said about the adjustments. But it is a problem. Yeah. So that's that. Now, fact 3. Oh, well, everybody wants to know about the bail-in of senior bank creditors. It is true that the EU and the IMF in the end insisted that the programme would not contain a bail-in of senior bank creditors. Many of the involved IMF staff had envisaged a partial haircut on senior bank debt, but in the end they were not supported. And you can read this in Tim Geithner's memoir, and he says something like, I thought the Europeans were crazy, something like that, and others. It seemed too risky in very still fragile bank bond markets, and so they just didn't want that. So there was interesting conflict between officials, but at the end the institutions all rode in and decided that actually there would be no bail-in of the remaining unguaranteed senior bondholders of Anglo and INBS. Actually, the Irish authorities had been planning how to deal with this situation, but then it got such a high profile as a result of all these debates that it wasn't easy to do anything after that. It might have been better if this matter hadn't been raised at all at the time. It might have been possible for the Irish to do something about it later.
And I think I remember from discussion that number is of the order of 7 or 8% of the year's GDP.
Well, yes and no. Yes and no. No, because if we confine it to the two completely failed banks that were eventually liquidated, Anglo-Irish Bank and INBS, it's only 4 or 5 billion, which is like 3% or something like that. You have to fold in the other banks, which are continuing banks now, and it is not clear that anybody had a very good idea of how to implement that in an orderly way. So it's easy enough to bail in the creditors of a bank that's being wound down, but two continuing banks that are the heart of the banking system in the country, it would have been interesting to try to pull that off. I don't know that I know any experience in any other country where that was pulled off very successfully. And then there's another related fact, that was November 2010, and 2011 the lenders again refused in March 2011 to countenance bail-in of the senior bondholders. Now, by the way, so it was hard to rationalise that in March 2011. Things had calmed down in the international markets, but it is a fact. well, I think I've talked enough about that stuff. Now we're on to another myth. This myth is about whether the Troika did damage to Ireland by changing policies, by forcing policies on the Irish government that were bad for Ireland. And I think that's just simply untrue. Now, what people call unfair issue linkage, it was certainly a danger. There was a danger that Ireland being in such a weak position that people on the other side would try to push unrelated agendas that they wanted Ireland to do things for years, and now is the opportunity to do it. But that was avoided. The danger was headed off, and the lenders didn't attempt to force, if you like, beggar thy neighbour policy changes in unrelated areas. Really, with debt restructuring off the table, the needed path of fiscal adjustment was pretty much an arithmetical calculation. Yes, the Troika did hold Ireland to a particular path of fiscal consolidation, but that was arithmetic, not a policy imposition. There was little, if you want to get the debt path back into clearly sustainable territory, left little scope for discretion. I think I've said already that in fact the arrival of the official lenders meant that, and the fact that the government still had cash balances, it allowed them to spread out the adjustment over a longer period of time. And by the way, the fiscal multipliers and the forecasting around the Irish programme were actually quite good. So sometimes you hear saying, well, it was obvious that they imposed austerity and the economy tanked. What could you expect? Well, actually, no. The fiscal adjustment was figured out. If you do this, this is what's going to happen to your economy, and it's going to recover. So the forecast, if you map, don't think I brought this slide. If you compare with some other recent countries, the path of GNP in Ireland, GDP, after the programme tracks very closely the forecasts. Doesn't in other countries. So I think Irish authorities also should take some credit for that, but also I think the team on the lender side. Yes, this was your question. Myth number 5. It was the euro that did in for Ireland. Now that's a myth. And so what I would say about that, we could have the whole talk could be about that. I think, yes, the euro contributed some fuel to the fire in the lead up, low interest rates that encouraged borrowing, and the removal of exchange risk on borrowing banks. I'm Anglo-Irish Bank, I'd like to borrow some money in the international capital market. What's your currency? Whatever, euros, we borrow euros. So removal of the exchange risk made it easier for the banks. But the euro wasn't an essential ingredient in the bubble. And after all, several other non-euro area countries also relied on this period of financial liberalisation and global savings glut to have their own little bubbles. Iceland and Latvia most prominent. And nothing in the euro regime prevented Irish regulatory and fiscal policy from moderating the boom. So when the crash came, the decision to guarantee the banks, well, flawed though it was in its design, blanket coverage, lack of prior consultation with the borrowers, it was actually underpinned by ECB liquidity support. So you certainly, the euro allowed it avoided a massive currency crisis, a massive crisis of default. True enough, if you're working with your own currency, you would have had a depreciation, which would have started an automatic competitiveness adjustment. So the competitiveness adjustment could only be achieved through internal devaluation means. But I think it's a big stretch to say, if you didn't have the euro, you wouldn't have had a problem. Yeah.
Can I just ask, was the decision to give the bank guarantee made by the Irish government in consultation with the European Central Bank or not?
No. As far as I know, and I've interviewed a lot of people, as far as I know, the Irish government did this entirely off their own bat, and were not in any way advised or pressed or encouraged or anything else by the European authorities, and in particular the ECB. So I think that's absolutely clear. I'm sure the ECB and the European authorities didn't want the Irish government to close down banks and have disorderly market conditions. But it's a very, very far stretch from that to say, oh, why don't you introduce a blanket guarantee covering, absolutely written down into law, not just a general political statement as was made by the German government or the Belgian government, and enforceable by all senior debt holders, subordinated debt holders, everybody. That leads to a partly true question, which is a little bit related to this, though that's 2008, now we're back up to 2010, and it's a partly true. The European institutions pushed Ireland into the EU IMF programme, and so it's a partly true. Why do I say it's partly true? I say it's partly true because if there had been an unequivocal public indication by Europe that it would continue to underpin the liquidity needs of the Irish banking system, well, that would have probably avoided the need for a programme. But it would not have avoided the need for austerity. So the ECB or whoever could have said, oh, don't worry about it. You think 31% of GDP that's only a statistical feature, the banks are going to be okay, we have emergency liquidity facility, everything's going to be okay. Then the markets would have said, it's quite clear that we'll be okay because the ECB is giving the banks loads, any money they need, so we don't need to withdraw our money. So there wouldn't have been that last drop off in the and so forth. But would that have been good, actually? I'm not so sure. First of all, the ECB would have probably say, well, the moral hazard of doing that. I mean, what adjustment is the Irish government? The Irish government had made lots of adjustment without the pressure, but if they were told, you're okay now, that would be their point of view. But actually, we probably would have been struggling along with quite high interest rates, nevertheless, and year to year, mini crises. Actually, given the level of heavy indebtedness, the major fiscal adjustment that had to go on, probably operating it under the protection of an official programme for 3 years, what gave us a better outcome in terms of lower interest costs and greater stability and certainty for planning of fiscal measures. So yes, they could have avoided the programme by underpinning it, but it actually, Ireland stood to gain more from a programme than to staying out of it. I have some charts showing the interest rates that really we've faced. And now complain again that I haven't shown all the months and zoomed in, and I'm sorry about that. But you can see there from the spreads over German rates start to get very high. I'm not sure they're lined up properly. Anyway, I don't want to spend a lot of time on spreads. These are the highest peak was after the programme, of course. The entry into the programme did not convince anybody because your 5.8% interest rates, evidently not clearly sustainable, and other problems in other parts of Europe. So the highest spike there is in June of 2011. There we are again. Yeah, there's the programme. There's the vertical line is entry into the programme November 2010, and you can see that interest rates bouncing along around just below 5% until around September, and then they start to move up, and there's all that history about the walk in Strand and Deauville and so forth, and when they get up to a spread of 500 and something basis points above Germany, then it's clear the game is up, and so you can't afford to pay 8%. So 5.8% seems not a reason, it seems quite a good deal if you can only get 8% in the market. And of course they went down a lot lower than that now. The Irish spread, 10-year spread over Germany now is about 70 basis points.
What did you say about where did that number?
5.8. 5.8 was the interest rate that the programme money was at.
Right.
So see, it's very high. Certainly high by today's standards, but it's not as high as 8-point-something%.
And is the sudden coming down of the green spike, is that Draghi whatever it takes?
No.
At that point?
What that is there's a summit which says I don't remember exactly the details of that summit, but it has. There's an idea. Various things are agreed, including some things that look likely to be very favourable to Ireland, including the treatment of the bank debt, and so everything. In one day, interest rates fell 100 basis points after that summit. So you can look it up at the end of. I think it's the end of June 2011.
And it's not the summit in which...
No,
yeah. It's not that, and it's certainly not the Merkel-Sarkozy meeting in which they said debt might be forgiven, which pushed things in the opposite direction.
Yeah, no, the
That
Merkel-Sarkozy thing, which said that the debt would be, they didn't say debt would be forgiven, they said there'd be a haircut on private debt if the public were to come in, and that happens just before the Irish programme in October of 2010.
way back then.
Yeah, and it is a trigger for Irish spreads to go right up, because immediately the markets say, whoops, that means us. We hold debt of certain peripheral countries. What's the worst one? Oh, Ireland.
Yeah.
Okay. So you hear this one. I think it's a myth. Ireland would have been better off with an IMF-only loan. Yeah, it's true that the experience and the hard-headedness of the IMF staff, it certainly kept the initial and subsequent negotiations on track, and it might have helped avoid false steps. So, all credit to them. But actually, I think if the European Union means what I think it means, it also embraces a degree and extent of collegiality that make European institutions natural partners in financial assistance for a member state that has come under pressure from distrustful markets. And for Europe to decline such a role would be a great step backwards. I think the member states of the European Union are bound together too closely for that. And so even if there have been some missteps in the handling by European institutions of the Irish crisis, and I prefer, and other crises indeed, I prefer to see this as teething problems. The terms and conditions of the overall European financial arrangements surrounding the Irish programme at its outset can readily be criticised. But they ended up in a different space. And I've talked about the lowering of interest rates, but there's also been a great lengthening of the maturities, much longer than IMF can give. And they definitely justified the persistence of Ireland in staying with the programme. Well, my last one is, oops, oh, I thought the next one was going to be, well, there you are. The conclusion one is the handling of the bailout produced a good success for the Irish people. Well, I think that's right. I'm just wondering where my last partly true. I think maybe I decided it was too boring. Yes, I think I've decided it was too boring. Where am I? No, we have another one. Yeah, no, it's gone. That's gone. We talked a little bit about sovereignty and the relationship between lenders and the state. I don't think it's a loss of national sovereignty that has struck me about this, as the extent to which the shared sovereignty of the European Union and the Eurosystem has been strained by the scale of the financial commitments involved and the loss of trust that was generated by the rapid emergence of these commitments. I mean, yes, the ECB lent sums in excess of 100% of Ireland's GDP to the Irish banking system. Bulk that's already been repaid, but having done so, it seemed to suffer a transitory lack of confidence that despite early fiscal and regulatory action by the Irish authorities, a lack of confidence that the national authorities would bring things under control. And as I mentioned, some steps were taken for the sake of avoiding spillovers and not specifically in the interest of Ireland. But on the whole, it's now beyond doubt that the interest and maturity terms that were ultimately arrived at for covering the financial commitments are such as to have made the whole operation a very good net success for the Irish people and for Europe. But I also think that the experience highlights remaining gaps in the institutional structure of Europe, even after creation of the banking union, which takes bank supervision and resolution out of domestic hands, as you know. It's less than a fiscal union, it's more than a currency union. It has survived a severe and divisive asymmetric shock, which has highlighted the importance of further institutional development. So that's what I had to say.
Thank you very much indeed.